Welcome to Blockchain Bulletin Unchained, a series where I speak to professionals and leaders from the industry to get to the heart of the latest news stories and overarching topics shaping this ever-evolving sector. I'm delighted to be joined with Mark Boiron, CEO of Polygon Labs, for episode 2. In this episode, Mark and I will explore the payment process of settling on the blockchain, from initiation to settlement, as well as where we are heading next with digital currency payments seeping into the traditional world. But first, Mark, thank you so much for joining me today. How are you?
I'm doing great. Thanks for having me. I'm excited for this chat.
Likewise as well, Mark. And I think it's going to be a conversation that a lot of our listeners and readers will take on a lot of information and valuable information at that. So, just firstly, Mark, can you explain the start of the payment initiation process for a user looking to perform a transaction on the blockchain for the very first time?
Yeah. I mean, before you even get to the transaction, you need to get to a point where you have funds that you can send, right? And so I always think of like the first step being you are going to create a wallet. This is no different from creating a traditional account, right? But in this case, it's a wallet on a blockchain. And when you create that, like what you're getting is this private key, which gives you the control to release funds from that wallet at any point in time. So when you want to execute a transaction, you're going to sign the transaction. And I view this like people think of this in a complicated way. I view this as no differently than I'm going to confirm that I'm going to release funds from my bank account. I'm now going to do the same thing on my wallet. The difference with the wallet is that there's a cryptographically signed signature, and the transaction is then processed, and you have it broadcast to the blockchain. And if we get really deep as to exactly how it works, and we could compare to exactly how it works in the legacy system, is you're going to have this transaction that gets broadcast to what's actually referred to as a mempool. It's basically a queue on a blockchain of transactions, right? And then eventually what you're going to get is you're going to get a block of a blockchain that's going to include the transactions from that mempool. And then you're going to have validators that are going to provide finality by validating that transaction. And that entire process of like broadcasting the transaction, including in a block, getting that finality is something that, on some blockchains, Polygon being an example of this, is, a 2-second or less process. And by the time you get that finality, your transaction is now sitting in the wallet on the other side of the person that you wanted to pay. So you went from paying in, days to paying in seconds.
Yeah, that's a great explanation. To be quite a great brief explanation as well to a very multi-layered process. So, Mark, can you also just compare as well I know a lot of the benefits and use cases when it revolves to paying with digital currencies and settling on the blockchain is the instantaneous process that it can settle in. Can you just explain a bit more and also maybe compare that to some of the traditional payments times of settlement and how they both differ when it pertains to actually settling the funds within almost instantaneously, should I say?
Yeah, one of the things that's very interesting about blockchains is that you can get basically near instant finality. And, a lot of times people compare the experience on a blockchain to that of using like maybe like a credit card payment or a debit card payment. And, they say that it needs to feel the same. But when you actually look at the end result of that payment, they're actually like very, very different. Right. And so even when you compare, I think, to like a credit card or debit card payment, you're at the point now where, when I go and I like swipe my card or I make an online payment, I sit there for maybe, I don't know, 2 seconds or so, and I wait to get confirmation that my transaction's finalized. On-chain payments using stablecoins or otherwise, you can actually create an even better experience. You can get that actual guarantee of payment within 2 seconds. But we can actually use some interesting stuff. We usually refer to them as pre-confirmations. You can actually pre-confirm that this transaction is going to happen in literally milliseconds. So what you end up getting is actually what I consider to be a better user experience than what traditionally occurs, where you can get a pre-confirmation knowing that your transaction is going to happen in maybe 50 to 100 milliseconds, and then you can actually have your actual confirmation in 2 seconds. Now, when you compare that to what is actually happening, traditionally, right? You've basically got like a origination where your bank is going to like you are sending a message via a card network or elsewhere of a payment being made. You're actually going to get the payment, being made days later, right? And so, that does, and you think of like the whole process days later, right? You've got an origination from a bank. You need to like actually clear that. There's going to be the netting of that, and then finally you're going to get an actual settlement, right? That entire process is something that is actually going to take, depending on the type of payment, like days. And you can even get, when you've got complex enough payments, meaning like cross-border payments to like smaller countries, more developing countries, more remote countries, you can like literally get to over a week before that settlement actually happens. Whereas that exact same payment, doesn't matter where it is in the world, you can still settle it in 2 seconds on a blockchain.
Yeah, and also I think when it also pertains to the payment lifecycle within settling on the blockchain, I know a lot of people who would probably have never settled a payment on the blockchain, but are curious. They're also curious about obviously the KYC, the security measures, the authentication measures. Could you also just explain some of those measures when it pertains to settling on the blockchain for the first time?
Yeah, so I think there's a couple parts of that are important. So first is when we think of like the regulatory aspect of this, we think about it very much in the traditional sense, right? Which is, where is there an intermediary who is actually, transmitting money in one way or another? So if you think of how you get money on a blockchain, you're always going to end up getting KYC to get money on a blockchain, because you are going to be relying on an intermediary who's going to be doing that. Once you're on a blockchain, that's where you actually have that friction that goes away. And the simple reason is that there isn't an intermediary anymore. It's actually sets of, hundreds of computers that are actually finalizing those transactions via some different like consensus mechanism. And so what we've kind of ended up with is regulators looking at that and understanding that there is no central party to that. And as a result of that, you don't need to KYC every single movement of money on a blockchain. It's really actually on the on ramps and on the off ramps. That being said, one of the benefits of blockchains is that they are very transparent. And so one of the nice things that's kind of like built up when it comes to being able to do, compliance in terms of understanding who's on the different sides of the transactions and monitoring those transactions, is really this idea of like transaction, like monitoring and analytics, like on a blockchain. And so specifically that ends up looking at like the sending address, the receiving address, tying those addresses to known bad actors and not interacting with them. You could do the same thing with like more complex transactions around like pools and things of that nature. And so it's kind of like a new form of, I guess, compliance that has grown on blockchains, where not only do you have like this, you're coming from like the traditional payment world onto a blockchain and you're doing KYC, but there's also like constant monitoring in a very transparent way that actually happens, on the blockchain. And then there's always like this last side of it, which is, how you're going to deal with, any kind of like issues that end up coming up on a blockchain. The thing is with that is that blockchains are unique in that they don't have the same type of issues as centralized players. And the simple reason for that is the decentralization that exists. What you end up getting on a blockchain, so where you get like one party who might like choose to reverse a transaction, or whose computers might go down and don't have proper redundancies, you don't get that on a blockchain, because you've got, hundreds of computers that are actually executing the same transactions, holding that same type of data. And so you actually do away with these risks of my transactions going to just disappear. I don't know what happens. Instead, what you get is you get replaced with cryptography. And that cryptography is really what's providing the guarantees. The like pure crypto people, they will often tell you like just trusted math, right? And funny way to put it, but the reality is that is what you're doing. You're trusting in the cryptography to actually, protect your transactions. You're trusting in cryptography to trust, like for your funds to actually be protected in your wallet. It's all really based in cryptography rather than human trust. So it's a different mechanism that comes down to getting a little bit kind of like used to a different world. I think the nice thing about the stablecoin world is that need for trust goes away, or that need for like trusted math goes away to some degree, and you get a little bit of everything. And what I mean by that is you have this trusted math where you've got your wallet and you've got your funds in it. But with stablecoins, you do have a centralized regulated issuer of that stablecoin who can still freeze that stablecoin, burn that stablecoin, and remint it. And so you kind of have this additional layer of protection when it comes to stablecoin that is very different from what you typically have in kind of like crypto transactions. And now you have like this double layer of protection. You have like the cryptography in addition to like the trust and like that centralized issuer.
Yeah, you broke that down really well then, and I think it's funny you should mention stablecoins because we're going to be speaking on that very soon. But it's also worth mentioning that there's also a lot of regulatory happenings going on, not just in the US, but like so many other markets as well. You look to Singapore and the UAE, and obviously Europe with the markets in crypto assets regulation now. They're also providing that groundwork and that framework for blockchain payments, such as using stablecoins. And I'll get onto stablecoins now with you, Mark. I just wanted to look into some of the use cases that we're seeing with stablecoin payments as of 2026. I know there's been a lot of use cases within cross-border settlement, and obviously, like we mentioned, that instantaneous settlement. But beyond cross-border, where do you see stablecoin payments branching out next within the traditional finance space? As I know, a lot of adoption and popularity is growing among some of these traditional finance players.
Yeah, so I think I first go to like what is the benefit of a stablecoin? I often refer to it as just 10x better money than what it exists. But the question is, what type, like in what use case is that relevant? And I'm a very big believer that in developed countries, the use for stablecoins is actually very low. I think there are some that like say like, hey, bring your stablecoin and come pay at like a local merchant. And like I honestly don't see the value add in that. Like I'd rather like use Venmo or like credit card. Like it tends to be easier. I don't think this will be true forever, and I can get into that. But for now, I think that's true. And so to me, the two use cases end up being cross-border payments and then payments in developing countries where the payments infrastructure might not be as strong. But in terms of like the type of payments, so obviously you can get like remittances as like the typical type of payment that comes up. I think there's payroll contractor payments is becoming a bigger and bigger use case. We recently had a Toku, which is like an EOR provider, go live on Polygon, for example, that enables stablecoin payments cross border. Treasury management is one that you hear a lot about, right? You think of all the idle cash that is sitting around the world for any global entity and the inefficiencies of them trying to move money via the correspondent banking network. It's much more efficient for them to use a blockchain to move money. Same is true when you would get to like things like marketplaces, for example, right? You've got like, thousands of sellers, creators. They're dealing with like delays constantly. They're also all around the world. Costs end up being high, uncertainty as to like where their payments are actually sitting. Instead, you can just send out a payment to 50,000 creators and all of them get it 2 seconds later at almost no cost. It's a significantly better system. So those are some like the ones that are top of mind. I think like we're seeing a lot of like pickup on fintechs and neobanks in general as well. Basically being able to give the flexibility to their users to say like, I want to send a payment, and whatever that use case might be, now they have the ability to do that in seconds. So those are some of the things that are top of mind. I do think, for what it's worth, that if we fast forward 5 or 10 years from now, this idea that developed countries won't be using stablecoins will actually flip. And you'll get to a point where you'll have blockchains that are being used and adopted in every fintech neobank, in every bank themselves. And at a certain point, you'll ask yourself, why are we using these traditional rails when 90% of my volumes are currently being done via these other rails? Or it'll be, I already have these other rails. They work great. They're actually better than the traditional rails, or the same. Why do I need 2 sets of rails? Why don't I like rip out our traditional rails and just rely on blockchain rails? And suddenly you get to a point where the only thing you're transacting in is stable coins, whether it's domestic or cross-border payments. And now you've gotten into a world where things are super simple. You literally just, pick up your phone and you make a payment. You're not thinking about like what network you need to use. You're not thinking about where the person is around the world. You're just making a payment. And that's really as simple as things should be when it comes to paying people.
Yeah. Yeah, I agree, and I think you're also kind of reading my mind as well, Mark, because the payment rails, is where I'm leading with you next, as we're obviously seeing this convergence now between DeFi and TradFi as well. I think there's also a I would say maybe I wouldn't say a demand, but there's also a curiosity there when it pertains to adopting both traditional payment rails and blockchain payment rails. What are some of the friction points at first for a company, let's say, looking to embed both within their infrastructure, but then also on the flip side, what are some of those positives of also having both a traditional payment rail and a blockchain payment rail running in tandem with one another?
Yeah, I think like if we're being realistic about it, all the friction ends up coming from the stablecoin Rails side of things, right? Because the traditional Rails are well known, they're well implemented, and so nobody's really like facing issues there. I think folks have done a pretty good job of understanding that bringing in stablecoin Rails is just bringing in another payment option. That's all you're
Mm.
doing. And when you bring in another payment option, then you don't need to make this complicated for your users, right? Like your users are simply going to say, I am using this new, I want to choose USDC instead of like ACH, for example, right? And that's okay. They can do that very simply. So when it comes to like the challenge though on the settlement, on the integration on the stablecoin side, there is like massive difficulty there, and that all stems from the fact that right now you actually have like 8 to 10 vendors that you're trying to stitch together, right? So you're like, okay, we got these traditional rails, we want to implement these blockchain stablecoin rails, and now what you're going to do is you're going to say, okay, I need to talk to a blockchain, I need to talk to a wallet provider, both a retail wallet provider if I'm going to provide retail wallets, but also an institutional wallet provider. I need to talk to an interoperability provider so I can support multiple networks. I need on and off ramps that are going to be supported. I need an RPC provider. You could go on and on about all the different components that you need. And this is the thing that like we've really seen at Polygon is that ends up being a process that takes like 8 to 10 vendors, which means you've spoken to like 25 to 30 different companies. And it's now taken you like 6, 12, 18 months to actually integrate. And like I strongly believe, and this is clearly like what we're working on at Polygon, is that you can have one API that gives you access to this fully vertically integrated stack. We call it the open money stack. And that when you integrate that, you now have the ability to, within a few weeks, in a very traditional integration of an API, to actually launch and offer global payments all around the world.
Yeah, so that was very brilliant explained, Mark. Yeah, but yeah, so heading into the next 5 to 10 years, we have sort of amalgamation of digital currencies, whether that be stablecoins with USDC and USDT, cryptocurrencies like Bitcoin, tokenized deposits as well with banks, and then also central bank digital currencies. Where do you believe are the best market opportunities for banks and traditional financial institutions when it comes to adopting some of these digital currencies down the line?
Yeah, I think it's important to just match what you're trying to do with the type of asset that you're using, right? And this is no different than what you do with any asset in the world. And I think a lot of times people get confused about this, but I've been in crypto for 9 years now, and I would never tell you that you should use like Bitcoin or Ethereum or Pol for a payment. Like it doesn't really make sense. That's not what those assets exist for. They exist to power different networks, or Bitcoin case to be digital gold. Like they have different use cases, and you need to use them for those use cases. I do not advocate using them for payments. They're just too volatile. And you can achieve everything that you want with something more stable, like a stable coin. Or to your point, you've got tokenized deposits, you also have CBDCs. So like when you start getting to those, that's when things get a little trickier. But I think the interface that you're interacting with is going to give you the answer that you need, which is you're not going to see, a tokenized deposit, which is really just a deposit at a bank, but in a token form, i.e. on a blockchain. You're not going to see that in the wild being used for, payments, all around the world outside of like their kind of like banking world. You're really going to see stablecoins being used for that purpose. And when you do get into like the banking world, then you're going to end up seeing tokenized deposits there. The reality is, if we fast forward 5 years from now, you're not going to know the difference. You're going to be holding a deposit, and it's just going to happen to be tokenized. And you won't even know, or frankly, you won't care that it's tokenized, except for the fact that when you do want to make its payment and you want to rely on a stablecoin for that payment because you want to do something that like a tokenized deposit doesn't enable you to do, you can literally exchange it for a stablecoin in, seconds and make your stablecoin payment in seconds. And now you get to a point where you're going from your bank to, paying somebody in the end in, again, seconds, regardless of where they're at in the world, even though you might be using tokenized deposits and stablecoins under the hood. Right. And then you get to CBDCs, right, which are central bank digital currencies. And that's when things start looking like very different. I think it's really hard to actually have a view on what those are going to look like, because they very much come down to what are governments going to require when it comes to CBDC. And ultimately, if you're the resident and citizen in a country, they can require it to be used in whatever way, right? So you could theoretically have a CBDC that becomes the sole payment method for anything that ends up happening, in that country. Unlikely they end up getting used heavily cross borders. I think you still see stablecoins end up being used for that purpose. But CBDCs, I think, are like the big question mark that, we've been talking about these for, I don't know, 6-7 years now. And you really haven't seen any major CBDC at any point. You've seen like a lot of like little efforts around them, but nothing major. And I don't really expect us to see anything major for still another few years.
Yeah. Well, it's going to be very interesting to see how the globe and how businesses adopt to all these digital currencies and how they transact on the blockchain for years to come. But that will bring us to the end of episode 2 of Blockchain Bulletin Unchained. Thank you so much, Mark, for taking your time out. We really appreciate it. And to all the listeners, if you would like to subscribe to the Blockchain Bulletin, please subscribe down below. Thank you.